Hello and welcome. In this chapter, we will discuss governance, internal control, audit readiness, and regulatory reporting under IFRS 9 or BFRS 9 in Bangladesh. In earlier chapters, we discussed classification, measurement, expected credit loss, data requirements, and model development. But one important point must be clearly understood. IFRS 9 implementation is not only an accounting or modeling exercise. It is a bank-wide governance and control process. The expected credit loss, or ECL, number directly affects the bank's profit, capital, financial statements, regulatory reporting, and stakeholder confidence. Therefore, the ECL process must be properly governed, reviewed, approved, documented, audited, and reported. A weak governance system may result in unreliable ECL numbers, unsupported assumptions, incorrect staging, weak documentation, audit observations, and regulatory concerns. So, the main purpose of this chapter is to understand how a bank can build a strong governance and control framework for IFRS 9 implementation. A proper IFRS 9 governance framework should clearly define who is responsible for what. The framework should cover board oversight, committee review, senior management responsibility, finance department role, credit risk department role, IT support, internal audit review, external audit coordination, model validation, documentation, financial reporting, and regulatory reporting. The main objective of governance is to ensure that the ECL process is reasonable, consistent, controlled, and auditable. The board and relevant committees should approve major policies and review significant judgments. Senior management should ensure proper implementation. Finance should ensure correct accounting and reporting. Credit risk should provide risk inputs and support staging and modeling. IT should ensure system reliability, data extraction, access control, and audit trail. Internal audit should provide independent assurance. External auditors should review whether the ECL provision and related disclosures are reasonable and compliant with applicable standards. In simple words, IFRS 9 requires teamwork. No single department can successfully implement IFRS 9 alone. The board of directors has ultimate oversight responsibility for financial reporting and risk management. The board does not need to calculate ECL itself, but it should understand the major judgments, assumptions, and financial impact of IFRS 9. The board should approve the overall IFRS 9 implementation strategy, ensure adequate resources, review major policy decisions, monitor significant ECL impacts, and review major audit or regulatory observations. The audit committee also plays a very important role. It should review the ECL methodology, adequacy of impairment provision, significant assumptions, management overlays, internal audit findings, external audit matters, and financial statement disclosures. The audit committee should pay special attention to high judgment areas such as stage classification, significant increase in credit risk, collateral valuation, macroeconomic assumptions, and management overlays. The Risk Management Committee should focus on the risk side of IFRS 9. It should review credit risk models, PD, LGD, and EAD assumptions, portfolio risk trends, sector-wise risk concentration, Stage 2 and Stage 3 exposures, stress scenarios, and forward-looking information. Since IFRS 9 impairment is based on credit risk governance is extremely important. A strong board and committee structure improves confidence in the ECL process and reduces the risk of unsupported or inconsistent decisions. Senior management is responsible for implementing the IFRS 9 framework approved by the board. Senior management should assign responsibilities to finance, risk, credit, IT, operations, and internal audit. It should ensure that the bank has approved policies, proper systems, reliable data, trained staff, and clear reporting lines. Senior management should also review ECL results before reporting, assess management overlays, resolve data and system issues, and communicate major impacts to the board and relevant committees. A successful IFRS 9 implementation requires active senior management involvement. If senior management treats IFRS 9 only as a finance department issue, implementation may become weak. But if management treats IFRS 9 as a bank-wide risk and reporting project, the quality of implementation will improve significantly. Now let us discuss the role of key departments. The finance department usually leads the financial reporting side of IFRS 9. Finance is responsible for accounting compliance, recording impairment allowances, preparing journal entries, reconciling ECL results with the general ledger, preparing financial statement disclosures, and coordinating with external auditors. However, finance cannot work alone because ECL depends heavily on credit risk information. The credit risk department provides the risk intelligence needed for ECL measurement. It supports internal credit ratings, significant increase in credit risk assessment, default definition, staging criteria, PD, LGD and HEAT assumptions, borrower risk review, rescheduled loan review, and forward-looking risk analysis. The IT department is also very important. IFRS 9 requires large volumes of data from core banking, credit, collateral, recovery, finance, and reporting systems. IT should support data extraction, system integration, access control, systems security, automation, backup, change management, and audit trail. If IT systems are weak, ECL calculation may depend heavily on manual spreadsheets. This increases the risk of error, unauthorized change, version control issues, and audit difficulty. Therefore, finance, risk, and IT must work together throughout the IFRS 9 reporting cycle. Internal audit provides independent assurance over the IFRS 9 framework. Internal audit should review whether the governance structure is effective, policies are approved, data controls are working, staging is accurate, models are properly validated, management overlays are approved, system access is controlled, and ECL outputs are properly reconciled. Internal audit should report weaknesses to the audit committee and follow up on corrective actions. External auditors also play a major role. External auditors review whether the financial statements are fairly presented in accordance with applicable financial reporting standards. In relation to IFRS 9, external auditors may test classification and measurement, staging criteria, significant increase in credit risk, PD, LGD and EAD assumptions, collateral valuation, macroeconomic variables, scenario weights, management overlays, data completeness, reconciliation with general ledger, and financial statement disclosures. Therefore, banks should maintain strong documentation and audit evidence throughout the year. Audit readiness should not start only at year-end. A strong internal control framework should cover the entire IFRS 9 process, from data collection to financial reporting. First, there should be control over data extraction. The bank should ensure that data taken from core banking, finance, credit, collateral, and recovery systems is complete and accurate. Second, there should be control over data upload and processing. Manual adjustments should be approved and documented. Third, there should be control over stage classification. Stage 1, Stage 2, and Stage 3 criteria should be clearly defined and consistently applied. Days past due, internal rating downgrade, watchlist status, rescheduling, restructuring, legal action, and non-performing status should be properly captured. Fourth, there should be control over PD, LGD, and EAD assumptions. Methodologies should be documented, reviewed, approved, validated, and compared with actual experience. Fifth, there should be control over forward-looking information. The bank should document the source of macroeconomic assumptions, scenario development, probability weights, and sector-specific judgments. Sixth, there should be control over management overlays. Overlays should be based on evidence, reviewed by finance and risk, approved by senior management or committee, and reassessed regularly. Finally, there should be control over journal entries, general ledger reconciliation, financial reporting, and disclosure preparation. Good controls reduce the risk of misstatement and improve confidence in the reported ECL amount. Audit readiness means that the bank is prepared to support its IFRS 9 calculations, assumptions, judgments, and disclosures before internal auditors, external auditors, and regulators. A bank is audit-ready when it can provide complete documentation. This includes approved IFRS 9 policy, documented ECL methodology, data source mapping, data quality reports, staging analysis, PD, LGD and EAD workings, collateral valuation records, macroeconomic assumptions, scenario weighting documents, management overlay approval, model validation reports, journal entry support, and financial statement disclosure workings. Common audit observations include incomplete data, weak documentation, unclear SICR criteria, inconsistent staging, outdated collateral valuation, unsupported overlays, lack of independent model validation, poor reconciliation, excessive manual intervention, and inadequate disclosure. Banks should not wait for auditors to identify these issues. Management should proactively review and resolve weaknesses before audit fieldwork starts. Banks and financial institutions must consider both accounting requirements and regulatory reporting requirements. IFRS 9, or BFRS 9, focuses on expected credit loss based on accounting principles. Bangladesh Bank may also prescribe regulatory reporting formats, loan classification requirements, and provisioning requirements. Therefore, banks should maintain clear reconciliation between accounting ECL and regulatory provisions. If there are differences between BFRS 9 impairment and Bangladesh Bank regulatory provisioning, those differences should be properly identified, explained, and documented. Financial statement disclosure is also very important. Users of financial statements should understand how credit risk is measured and how impairment allowance has changed. Disclosures may include accounting policy for impairment, ECL methodology, credit risk management practices, basis of staging, movement in loss allowance, changes in credit risk, key assumptions, collateral information, write-offs, recoveries, and concentration of credit risk. Apart from statutory reporting, management should also receive internal IFRS 9 reports. These may include stage-wise exposure, portfolio-wise ECL, product-wise ECL, sector-wise ECL, Stage 2 migration trend, Stage 3 exposure, provision movement, top ECL contributors, macroeconomic scenario impact, and management overlay summary. Such reports help management take timely credit risk decisions. In Bangladesh, IFRS 9 implementation should consider local banking realities. Important issues include alignment between BFRS 9 and Bangladesh bank requirements, loan rescheduling and restructuring practices, sector concentration, collateral valuation, legal recovery delays, manual data processes, system limitations, and shortage of trained resources. Banks should also pay attention to documentation of management judgment. In many cases, judgment will be needed because historical data may be limited or systems may not be fully automated. However, judgment must be reasonable, supportable, and properly approved. For successful implementation, banks in Bangladesh need cooperation among finance, risk, credit, IT, internal audit, external audit, senior management, and the board. Let us summarize the key points of this chapter. Governance and internal control are essential for successful IFRS 9 implementation. The Board, Audit Committee, Risk Management Committee, Senior Management, Finance, Risk, ET, Internal Audit, and External Auditors all have important roles. Strong controls are required over data, staging, models, assumptions, overlays, journal entries, reporting and disclosures. Audit readiness depends on clear methodology, reliable data, proper documentation, reconciliation, and evidence-based judgment. Regulatory reporting should be aligned with Bangladesh and BEC requirements, and differences between accounting ECL and regulatory provisioning should be clearly reconciled. A well-governed IFRS 9 framework improves financial reporting quality, strengthens credit risk management, supports regulatory compliance, and increases stakeholder confidence. In the next chapter, we will discuss disclosure requirements and practical reporting templates under IFRS 9, BFRS 9. Thank you for watching.